Welcome to Yahoo Finance Live and happy Friday. I'm Shauna Smith along with Akiko Fujita. Let's get you up to speed on this afternoon's market action as we wrap up the final hour for the trading week. You're looking at losses across the board, although we are just off the lows of the day. The market's heading to the downside here after GOP negotiators walked out of debt talks earlier this afternoon. You have the S&P in the red on its way to snap a two-day winning streak, if you want to call it that we have seen in the major average here over the last two trading days, failing to stay above that 4,200 level that we know has been so critical here for investors. We also have banks sliding today. Reports there that Yellen had told bank CEOs that more mergers may be needed. The XLF, one of the worst performing sectors of the day. We're also seeing some weakness in consumer discretionary there at Kiko. Foot Locker, the latest to report on the retail front and showing some signs that consumers once again are pulling back on their spending.
Yeah, Shauna, we're seeing those declines in the market today, despite the Fed talk that we got today. Fed Chair Jay Powell speaking during an event earlier, suggesting a pause in rate hikes could be on the table because of the stress in the banking system. Take a listen.
While the financial stability tools help to calm conditions in the banking sector, developments there, on the other hand, are contributing to tighter credit conditions and are likely to weigh on economic growth, hiring, and inflation. So as a result, our policy rate may not need to rise as much as it would have otherwise to achieve our goals. Of course, the extent of that is highly uncertain.
So, Shauna, the Fed chair, they're talking specifically about these tools the central bank has to essentially stabilize the banking system, the financial market, saying, while they're supposed to be independent, one could potentially inform the other. In other words, that could affect the monetary policy that they're looking at, and that could lead to rates not going as high as initially expected. Now, it's worth noting that after the last meeting, we have heard from some Fed officials who've sort of implied a potential pause coming in the next meeting here. But interesting to watch the moves in the Treasury market, specifically on the back of this. It feels like there's some optimism that's starting to seep in here that there could be an economic rebound, but more importantly, that inflation could be tamed without the kind of hard landing we've been talking about for some time.
Yeah, exactly. Nikiko, I think just look in the pricing action that we have seen in the markets, what we've seen in the Fed funds futures in terms of the CME, that tracking tool there. I think investors are having a very hard time trying to predict what we are going to get from the Fed next month, if in fact we will get another 25 basis point hike, or if the Fed is okay with leaving rates where they are today. We know that Fed Chair Powell has said time and time again that there is a bigger risk of not being aggressive enough on inflation rather than taking that wait and see approach. So he was a little bit optimistic. That's at least how the market is viewing that in terms of the fact that the Fed might be done raising rates for now. But like you said there, he was very quick to couch that, saying that the Fed is going to stay, quote, steadfast on its goal to reduce prices. And we heard from Dallas Fed President Lori Logan earlier this week, and she was saying that the economic data right now is not enough to support a rate pause, at least just yet, when you take into account the strong retail sales data that we've gotten out earlier this week. The fact that the housing data actually was pretty good, relatively speaking. So I think it's too early to tell at this point.
And Shauna, you pointed to those comments we got from Jay Powell before about doing too much versus too little. The one thing that stood out to me, what we heard from today, he said the risks of doing too much versus doing too little are now becoming more balanced. And that would sort of indicate maybe where they are leaning now. By the way, we're talking about Treasury yields here. What we saw today in the 10-year climbing to the highest levels since the SVB collapse. So that points to where the sentiment is moving. The 10-year now at 3.7%. Of course, we're going to be watching, as always, where the Fed moves come the next meeting. But 10 straight hikes is what we've seen so far, and it feels like increasingly there could be a potential pause.
We will see. All right, let's talk a little bit more about this, the fight to get inflation back to 2%. For more reaction on Powell's comments today, I want to bring in Eric Friedman, U.S. Bank Asset Management Group Chief Investment Officer. It's great to see you here. So at least from the start, it looks like the markets were encouraged by what they heard from Powell, sent the markets though right back down to the downside after GOP negotiators walked out that debt ceiling deal. But when it comes to Powell's comments here, Eric, how do you read that? Do you think that it is likely that we could see a pause?
I think it is very likely that we'll see a pause. And I think that the bar is actually very high for the Fed to come off of this sort of wait and see mode that they've signaled. I mean, there's only a 16% chance priced as of the second in Treasury markets that we actually could see a June hike. And so it's, again, not off the table completely, but I think the Fed is recognizing that you have a confluence of a couple things happening. I think you certainly have concerns about the lending industry. You have concerns about the cumulative impact of hikes already made, but then also two variables that probably aren't getting enough attention. One is the potential for China to actually draw back on liquidity injections. That's something that really we don't think is enough talked about in the capital market lexicon right now. And the second variable would be what happens if and when the debt ceiling talks do ultimately find some resolution. What's going to happen is the Treasury is going to come back to the market and issue debt. They're going to sell securities. Capital's going to come out of the system, pay for those securities. And that really leads to just less capital sloshing around the system, so to speak. So I think the Fed understands that you have this confluence of events that again, suggests that they should probably wait and see what the cumulative impact has had versus forcing perhaps even more liquidity to drain out of the system relative to where we are right now.
You know, on that point, Eric, it was interesting to see the market reactions today. On the one hand, you've got the Fed chair sort of implying that, you know, potentially there could be a pause on the table here. And yet it really was the headlines coming out of DC and that pause in discussions around the debt ceiling that seemed to drive the market to the downside. I mean, does that suggest where the risk, or at least where investors see the risk right now? Because all indications are that, at least, you know, on both sides, what we have heard from Republicans and the White House is that they're not going to go right up to the X date. They don't expect a default.
Yeah, Kiko, I think that's very well put. I mean, there's the risk that both sides really have concerns about the perception of either Democrats or Republicans being basically associated with a hang-up here. And I think that the risks are too great on either side for this to be prolonged. I think the fact that you had some discussion that, you know, there were aides getting together over the weekend and that there may be a bill on the floor on Monday or Tuesday, that you know, suggests in terms of the commentary from Washington today that actually may in fact not happen. So I think this is one of those things that as a professional investor, one of the things that we think about is where do we have an edge? And the comings and goings of what may be happening in Washington are really not what we consider to be a high edge environment. Even though we have people on the street in DC and we of course have great connectivity there, you have to be really mindful and respectful of the amount of variability that could happen between now and a resolution. So again, more noise means more potential volatility. We do think a deal will be met. And again, both sides are worried about being the proverbial scapegoat on this being pushed beyond or even up to the X date, as you mentioned.
Eric, what do you make of the market's performance, not only here in the U.S., but really what we have seen globally? And taking a look at the reaction today, yes, markets are in the red. Before the year, we're certainly up pretty significantly. The S&P just briefly trading above 4,200. What do you make of the current valuations, especially the run-up that we've seen in tech names?
Yeah, you know, it's been a really interesting run-up, particularly in the international developed side. That has been, again, what we do. Part of what we do is we manage tactically asset-allocated portfolios. And so being really underweight Europe had been a significant source of alpha for us for a long time. And we took that view off earlier in the year. The reason for that is because we just felt that the story was getting a little bit better. Not saying that things in Europe are going, gangbusters strong, if you will, but there was a real negative scenario coming out of the unfortunate Russian and Ukrainian conflict, where Europe was going to be in a tough position with respect to energy and energy prices. It was a warmer winter, and that actually helped things out. And you're seeing some consumer activity both in Europe as well as Japan. So I think that the international story has been probably less focused on. Again, the DAX flirted with an all-time high earlier today in Germany. So there's been some really strong momentum there. I would say that, you know, the knock that everyone has about this market is that it is a very, very narrow leadership market. You've had tech, and in particular, a couple of stocks that have done quite well. Valuation is actually not a tailwind for domestic equity markets. We are actually smack in the middle of a 20-25 year, either on a trailing basis or a forward-looking basis. You don't have a lot of valuation support with respect to saying this market is exceedingly cheap. So I do think that what bulls have to get excited about is, again, that run to 4,200. A fail at 4,200 on a closing basis would be an issue that the bulls really have to be forced to focus on. But I would say that the other side of that, of course, is if you look at the breadth of sectors it has been very narrow so far this year. So bottom line is that we still think that, again, having some emphasis on income with respect to sector allocations, again, energy has been a weak point, utilities have been a weak point. We think those are interesting. Those are things that you can really get paid as you wait, if you will, to see if we have a pronounced breakout above 4,200 with broader sector representation. If we don't have that broad sector representation, we'd be more skeptical about this rally higher.
Eric, you're talking about your international exposure. What's your exposure to Japan right now? To your point, we saw the Nikkei hit a 33-year high. There's a number of factors that we have seen there play out. It's corporate governance reform. It's the Bank of Japan still being an outlier with ultra low rates. What makes this market attractive for you right now?
Yeah, I think there's a couple of things. One is, as you highlighted, you have a little bit of corporate governance reform, and again, the knock against Japanese equities has been that you still have those conglomerate type of entities that are difficult at times to invest in, because there's just layers and layers of potential revenue growth, but there's also layers and layers of expense that are hard to tie back to. So I think that a little bit of a shakeup there is a positive. You certainly have some turnover at the central bank office, which again, I think you have a very solid academic who is both a practitioner as well as an academic in the chair right now, recognizing that monetary policy is not the cure-all for what's happening in Japan. And again, the demographic situation is continually challenging for Japan. I think that the country recognizes that, and so potentially being creative on immigration or on labor mobility, those are things that are positive. So again, I think that you're seeing a little bit more flexibility with capital, which is a good thing. We don't think the Japanese demographic story will be solved overnight, but it is a place that we think offers a decent risk reward, which is something we really couldn't say a couple of years ago.
Eric, bringing it back here to the U.S., some of the retail trends that we have been seeing, certainly a massive story this week, as we heard from Target, Walmart, TJX, just to name a few. We got a mixed bag when it comes to guidance, but there does certainly seem to be a trend that's developing, and that's that the consumer is a bit more cautious and they are trading down. What do you think this signals about the economy and really market implications here on out?
Yeah, it's a great observation. If you throw another log onto the fire, you look at what's happening with luxury goods retailers, which are just, again, have been outstanding performers. So the consumer has been a very, very difficult animal to track, if you will, over the past couple of quarters. And you're seeing that with, again, big box retailers as well as some of the e-tailers. And the trends that we're seeing are more of an emphasis on experiences, so travel, leisure, hospitality, less on accumulating stuff. That's true not just domestically, but also with China in particular. So what do we think that means? We think that again, the consumer has still got some capital saved up from stimulus savings. The consumer, though, is now starting to put more things on credit. And I think the Fed understands that if they keep rates high or if they keep increasing rates, that we could see a consumer that faces a really challenging environment as we get deeper into this year. So again, our viewpoint is that we're really more market weight with respect to the discretionary side right now, but we're likely to become a bit more bearish as the year goes on, because we think the confluence of higher interest rates, lower liquidity, and again that trend that you cite, that trade down, if you will, does suggest that the consumer is in a little tougher position than they are, or maybe than they were 3-6 months ago.
So what does that mean for you in terms of positioning? We're coming on the back of a week where we heard from all the big box retailers. What we're learning is that there's a similar narrative, and then we're also seeing the differentiation between a Walmart, for example, that leans more towards groceries, and then a Target. I mean, how do you look at all of that? Is it more about the very highly focused groups like travel in that area, or is it about going for those retailers that are a little more diversified?
Yeah, we don't really have a strong view at the tactical asset allocation level about retail domestically per se. We're really more market weight at this particular juncture. I would say that the things that we are very focused on would be the potential for travel to kick in and kick up. So one of the things that we think is often ignored in terms of people's investment psyche is infrastructure. So think about ports, not just airports, but also toll roads. These are again, they do well when people get out more. They actually have some inflation adjustments embedded in their pricing. So those are areas that we think are often underloved in capital markets. And they also spit off a bunch of current income and yield. So that's an area that in terms of travel and consumer changes, if you will, that's probably the area that we have the most conviction on. And certainly from an absolute performance standpoint, we think there is some valuation support at current levels. So probably a stronger view about infrastructure and hospitality than in retailing per se right now.
Makes a lot of sense given the current environment. All right, Eric Friedman, U.S. Bank Asset Management Group Chief Investment Officer. Thanks so much. Have a good weekend.
Well, Morgan Stanley CEO James Gorman announcing today he plans to step down from his role leading the firm within the next year. Yahoo Finance's David Hollerith is following the story for us, and he joins us now. David, how do we look at this in the context of the other banks? James Gorman's been there for a long time. What does the succession plan look like?
Yeah, Kiko. So this has been talked about for a while now, and they mentioned Gorman mentioned on the call today that there are three planned potential CEO incumbents who are all internal employees. But Gorman, just as far as his legacy goes, he is really known for reshaping Morgan Stanley after the great financial crisis into, a more diversified bank, especially a wealth management powerhouse. He led the bank's acquisition for most of Smith & Barney, which was sold by, at the time, a cash-strapped Citigroup in 2009. Since then, he's become CEO, and Morgan Stanley shares have gained about 180%, outpaced by the S&P 500, but that's far better than the banking sector's index. So more recently, it's kind of interesting. Morgan Stanley has shown a lot of strength as compared to the regional bank turmoil. They're well insulated from some of that. And as part of that, Morgan Stanley was a part of the rescue effort to First Republic Bank. And they contributed $2.5 billion to that effort. And while the rescue didn't change First Republic's fate, Gorman did say in April that Morgan Stanley was seen as part of the problems in 2008. And 14 years later, he was very gratified to have the bank be seen as part of the solution.
Yeah, certainly a number of changes under Gorman over the last decade plus here. David, this is not the only executive shakeup that we're seeing play out on Wall Street today. Another new chief executive at Lazard. What are we learning?
Yeah, this happened actually yesterday. Lazard CEO Ken Jacobs, he's also 64 years old, as Gorman is. And like Gorman, he started in late 2009. Gorman started in early 2010, same period though. And his succession is a little bit more solidified. Peter Orszag is said to become his successor, as Bloomberg has first reported. But the succession topic obviously kind of brings back the largest bank back into the spotlight, JP Morgan, which is going to have an investor day on Monday. Jamie Dimon has reigned as CEO for years of the bank, and he's rebuked sort of discussions of him leaving anytime soon. But that being said, he started in 2005 and he's 67 years old. So investors are going to be keen to hear any more details in terms of what that looks like. That being said, he has agreed to stay on for at least 5 years, which was back in 2021. So he does have a few more years to go, at least by executive compensation.
Okay, we'll see if we get any hints during Investor Day next week. David Hollerith, as always, thanks so much for that. Well, we are just getting started here on Yahoo Finance Live. Coming up, President Biden in Japan as world leaders gathered for the G7 summit in Hiroshima. We take a closer look at the key themes there. Plus, Instagram now looking to take a page from Twitter's playbook. The social media giant's latest move, we'll discuss on the other side. And we're joined by the CEO of Tanger Outlet, Stephen Yella, for a vibe check in the retail sector. All of that and much more coming up here on Yahoo Finance. Stick around. Well, the U.S. is tightening economic sanctions on Russia. The Biden administration adding more than 70 companies to a trade blacklist today while halting the exports of a wide range of consumer goods. It's part of an effort by the world's wealthiest countries to up the pressure on the Kremlin as world leaders gather for the G7 summit in Hiroshima. Let's bring in Charles Kupchan, Council on Foreign Relations Senior Fellow, as well as Professor of International Affairs at Georgetown University. Professor, good to talk to you today. This, of course, comes at a very critical time as Ukraine prepares for its counteroffensive. If the ultimate goal is about finding some kind of diplomatic resolution to this fight, how did today's actions help the U.S. and G7 countries get there?
Well, I think there are two lines of effort that have been very successful. One is providing economic assistance to Ukraine, and the other is bolstering NATO's eastern flank. The third line of effort, sanctions against Russia, they've been less successful because it's been very hard to close off the Russian economy. They have simply realigned their supply chains. They're selling oil to the Indians and to the Chinese rather than to the Europeans. They're getting goods from the South rather than from the Europeans. Will these new sanctions make a difference? Maybe at the margins, but I don't think we're going to see a successful strangling of the Russian economy. For now, I think what we're going to see is the playing out of this offensive. And there was an announcement today to start training Ukrainian pilots, high-end aircraft, including F-16. So the action is now on the battlefield. When this offensive does come to an end later this year, I think then the window will open for a possible diplomatic endgame.
Charles, when it comes to the F-16 fighter jets, how big of a step is this? And you mentioned the fact that what the U.S. and its allies have done with Russia hasn't worked maybe to the degree that we were hoping it would have. So what is the better strategy then at this point?
Well, I think that the message that the G7 is sending to Moscow is don't think that you can just wait us out, that our sanctions are getting stronger. We know that you've been finding loopholes and we're going to try to fill them. The message here is, ultimately, you're going to have to back down. Ultimately, time is not on your side. And the other side of the coin is we are increasing Ukraine's ability to push into those areas of Ukraine that are still occupied by Russia. And the bar has moved over time. A few months ago, we weren't giving Ukraine tanks. Now the Europeans and the Americans are sending tanks. Until today, the U.S. was saying no to high-end aircraft. Now we're going to start training pilots. But it's important to note it takes a long time to train pilots, probably as many as 18 months. So these are not aircraft that are going to be there for this offensive. Most of what the Ukrainians need to carry out this offensive, they already have. I think they're basically waiting for the mud to dry up so that they can use their armored vehicles and tanks to good effect.
Charles, I want to talk about another issue that is going to be raised here at the G7, and that is about industrial policy. There's a number of threads, but specifically on semiconductors. What we have seen is, on the one hand, the likes of the U.S. as well as the EU offer these really aggressive incentives to try and onshore a lot of the production. At the same time, we've seen conversations between the two sides, as well as Japan, to try and box out China. What's that next step we're likely to hear in Hiroshima?
Well, I think the conversation about China is much more difficult than the conversation about Ukraine. Ukraine, everybody agrees, Russia has committed a bold act of aggression, and the West needs to stop the Russians. When it comes to China, I think the question is, yes, we are too interdependent. We need to friendshore certain supply chains. We need to prevent them from getting the best semiconductors because that's where the cutting edge technology lies. But beyond that, I think there are some differences beneath the surface about how far to go, about whether decoupling should turn into a broader deglobalization. Right now, I think the U.S., its allies in Europe and Asia agree that this should be selective, as Jake Sullivan puts it, small yard but a high fence. I think what we don't know is as geopolitical rivalry mounts between the US and China, is this going to turn into a broader deglobalization, a fragmentation of the global economy? We don't know the answer to that question yet, but it's certainly on everybody's minds.
To what extent does that get hashed out at this G7? I mean, to your point, you've got the likes of Japan, for example, saying, yes, we are on board with the US policy. It's a little more questionable when it comes to Europe. Largely, some of those chip makers still supplying to the Chinese. You look at, for example, the Dutch, who have said, look, we're willing to go with some of the policy, but we're not 100% on board. Are we likely to see any progress on some of those differences in this meeting?
I think the answer to that is yes. And that's because we are still in a small and confined space. That is a certain amount of semiconductors preventing the Chinese from getting these machines that are needed to produce them. The bigger question, I think, is what next? Where do we draw the line? If we're going to ban semiconductors, what about avionics? What about aircraft parts? I don't think this is a conversation that's going to happen at this G7, but beneath the surface, this is a conversation that's taking place. It's important to keep in mind that when Emmanuel Macron and Olaf Scholz, the leaders of France and Germany, went to China recently, they had dozens of CEOs with them. And that's because Europe is highly dependent on trade with China. So is the United States. So this is very much a work in progress. But we know from history that when geopolitics gets in the way of trade, geopolitics usually wins. And that's why we need to keep a close eye on this space.
Charles, always good to get your insight. Charles Kupchan, Senior Fellow at the Council on Foreign Relations, as well as Professor of International Affairs at Georgetown University.
We are keeping a close eye here on two big movers in the retail space today, Farfetch and Foot Locker. Yahoo Finance contributor Remy Blair on the floor of the New York Stock Exchange with the details. Remy.
Well, it is a tale of diverging trends in consumer spending. Both Farfetch and Foot Locker reported earnings, and we saw shares of Farfetch rally earlier in the session by over 20%, and Foot Locker fell by as much as 30% in Friday's trading session. Now, one company's results tells a story of luxury's target market, but the other company shows a pullback in discretionary spending and focus on essentials. UK-based Farfetch beat earnings in terms of their latest quarterly results, and shares were higher with trading volume up to 7 times the daily average. But keep in mind that although we got that pop in Farfetch today, shares prices are still well off pandemic highs, which topped above $70 a share. Now, if you're looking for Prada, Gucci, or perhaps pre-owned Chanel, Farfetch may be your shopping destination. Meanwhile, Foot Locker shares tumbled today, and right now they are hovering near session lows ahead of the closing bell. Earnings came in weaker than expected, and the sports retailer also missed on top and bottom line and also cut its guidance. The company also says that heavy discounting as well as an uptick in retail shrink or theft led to margin losing a considerable 4%. This week, we got a slew of earnings out from big box retailers, including Walmart, Home Depot, and Target, and they say that they saw fewer purchases of big ticket items as well as discretionary purchases. As we look at the week ahead, we will be getting earnings reports out from Best Buy, Lowe's, and Costco, and that will give us even more perspective on consumer spending.
Certainly will. All right, Remy Blair, thanks so much. Well, we are sticking with retail straight ahead. We're taking a look back at some of the biggest retail earnings of this week, talk about those results, what it tells us about the state of the consumer. We'll be right back. Retail has been a big story this week as investors have dug into earnings reports from Target, Walmart, Home Depot, just to name a few. One of the big takeaways from this week, companies calling out the cautious consumer.
Consumer spending patterns continue to evolve, putting significant pressure on our discretionary categories.
This stubborn inflation in dry grocery and consumables is one of the key factors creating uncertainty for us in the back half of the year because of the cumulative impact on discretionary spending and other categories, specifically general merchandise.
The low-end customer continues to be pressured, whether it's ongoing inflation, reduction in SNAP benefits, lower tax refunds.
The newer dynamic now that we're really seeing again this past quarter is a more cautious consumer, given the broader macro concerns, including credit availability.
Joining us now for more on this, we want to bring in Jerry Storch, Storch Advisors CEO, also former CEO of Toys R Us. We also have Anisha Sherman, Bernstein, a senior analyst here to help us break down all of these reports. Jerry, first to you, just in terms of this cautious consumer message that we have gotten time and time again over the last 5 days. What does that signal just about some of the cracks that we're starting to see?
Well, it's not new. This is very predictable. The consumer actually started to slow last summer, and it's been pretty much a straight line since then. For the last 8 months now in a row, retail sales have been negative when adjusting for inflation, when you look at it on a year-over-year basis. And that's how retailers think about it. That's how the reports come out. What's your comp sales? How did this year do compared to last year? And the answer is, for the economy as a whole, it's been negative and getting worse for 8 straight months. The consumers are increasingly stretched, and they're running out of money, and they're leveraging up their credit cards.
And Anisha, are we starting to see some of that bottom out, or at least starting to see some of that improvement? And what do you make of the way that some of these retailers, especially the big box names that reported this week, have adjusted to that?
I think what we're seeing differently this year, I agree that overall the sector has been pressured, but what we're seeing differently this year is last year, the mainstream and premium consumer was doing great. I mean, if you look at the numbers of some of the mainstream and premium brands in the sector, they were growing double digit in North America. And they are now comping off some really tough numbers from last year, and their consumer is starting to pull back. The low income consumer has been under pressure for over a year now. And so, I think what we're seeing differently than what we did a year ago is some trade down. So we've seen transactions at Walmart, at Target, at TJX, at Ross, positive year over year, which suggests that there is some trade down coming into the value side of the equation as some of those mainstream consumers make different choices. And that's what some of the new data is showing that wasn't the case last year. So for value retail, I think it's a positive. I mean, they continue to see their low-income consumer being pressured. That's not changed. What they're seeing differently is some people opting into value that used to be buying more expensive items, 6, 8, 9 months ago.
Jerry, that trade down trend that Anisha is talking about, is that trend here to stay? And aside from Walmart, who's best positioned for that?
Well, it's here for a while. Since 1961, when both Target and Walmart were founded, in tougher times, Walmart does better, and in worse times, Target does better. In good times, Target does better. These are definitely not good times, and you see that even though everyone talks about the consumer being pressured, Walmart's comp sales were a 7%, 7.6% or something, very high comp sales. Target was flat. Walmart was way up on the internet. Target was negative on the internet. So Target's really just not made sort of to function in this kind of environment, whereas Walmart, with the heavy emphasis on food, consumables, and value, really is. So I think Walmart is absolutely positioned to do well here. And so all the value retailers really are, as you just heard. I think that's true. I do think, though, there's a big gap between people like Target or a Costco, who on the one hand, Costco will do great in any environment, Target will not, to Walmart and a Ross, even though they're all value stores. See Walmart with the food being able to do well. A consumable purchase like apparel are not going to do as well. So, there's companies like Five Below that I think will look very strong throughout. Value player, kind of neato type of merchandise. So there'll be winners and losers. It's not all boats rise. And just because you have value attached to your name doesn't mean you'll win either.
Yeah, Anisha, interesting comment here from Jerry, because he talks about the gap that we're seeing within the value names, but we've really seen a huge gap between value, everyday purchases, and then the luxury consumer, which has been largely resilient. We were talking about luxury watches yesterday, still doing really well. How sustainable is that? And are we starting to see any cracks on that end?
For high luxury, no. That consumer is not subject to some of these pressures that we're talking about. Inflation, fuel costs, it's really not impacting a consumer that is buying high luxury. Now, in the mainstream side, if you're talking about slightly above mainstream premium, absolutely. They are the ones who are trading down. And, even last quarter, we saw Macy's, Nordstrom, Kohl's, all the department stores, many of the mainline brands talking about losing traffic, because those consumers are the ones who are pulling back, and they are now opting into value retail. So putting food aside, obviously food spend is different and it's more inelastic. Discretionary spend, yes, the mainstream consumer is pulling back and making different choices than they were making a year ago. And that is benefiting some of the lower end retailers, but it's not the high luxury consumer. That is still going strong and is unimpacted by some of these macro headwinds.
Anisha, what about inventory levels? There has been such a focus on that leading up to this quarter. We saw some improvement from Target, from Home Depot was flat, Walmart's also declined. Have retailers fixed this problem, and how big of a boost do you potentially see that to margins?
We are way past the peak. Retailers have made a lot of progress, and we heard it even from them in Q4. We've heard it in our channel checks. They've offloaded a lot of inventory. Now, where's it gone? It's gone to liquidators, jobbers. A lot of it was sold into off price, where they're holding it in pack away to sell through to the consumer later. So it's not out of the system yet, but many of them, the leading brands and retailers, have cleared it off their balance sheets. We're past the peak. They're still clearing, but we're past the peak of it, and they're ordering much lower. So, the net effect is going to be declining over the course of this year. That said, it's still in the system. So it's not coming out of the system, I think, at least until another 3 or 4 quarters, depending on how strong demand is. Because that's the other side of it, right? They can't sell it through if there isn't demand. So if demand continues at the trend it's at now, I think Q1 24 is the first we'll see where the system is clean. If demand continues to decelerate, it could even be further along.
Jerry, when you put together economic data that we've gotten so far on the consumer, you mesh that with what we heard from executives on these earnings calls this week. Who do you think is best positioned right now? Who's operating from a place of strength when you look at the retail landscape?
Well, I think we've been through it. There's not much doubt that Walmart's in a very strong place. And keep in mind, it's not just that they know how to operate in these times; it's that they really are heavily focused on food and consumables, and that people have to buy and do. And they trade into Walmart in tough times. And Walmart's the nation's largest grocer, and they're gaining share. And so they are exceptionally well positioned. I think Amazon's another company that it's very complex to analyze because of the cloud business and the retail business, and all the pieces that are flying around there. But you notice the internet is back growing again faster than bricks and mortar. And Amazon, in many ways, still is the internet. We saw great performance in the internet by Walmart, but very poor performance by Target. And so meanwhile, I'm not embarrassed to admit I order something from Amazon almost every day of the week. And I think most of us do, if you really look at it. So I think they're in a very strong place as well. And so many of the trends that we saw pre-pandemic are reasserting themselves with a heavy value focus at this time.
Yeah, you are certainly not alone in your Amazon orders there, Jerry. Jerry Storch and Anisha Sherman, good to talk to both of you today. Have a good weekend. Well, coming up, we go around the horn and check in on a few top stories and trending tickers as we continue to count down to the closing bell. Stick around.
To count down to the closing bell, let's take a look at some of the top trending stories of the day. We spent a lot of time this week talking about retail. Let's take a look at the luxury consumer. High-end retail has certainly been a standout now for some time. Higher income earners keep spending. Well, there's a headline out of the Journal today that Chanel is challenging Hermes in the bag war. Now, for the first time ever, Chanel's most popular handbag, this is a classic flap handbag, you're looking at the Birkin right now, is more expensive than an Hermes Birkin. Okay, so the price of this Chanel bag up 75% in just the last 3 years. It cost less than $6,000 in 2019. That's still very, very expensive. Today, it's going to set you back over $10,000. Chanel saying that the price hike is due to inflation and exchange rate shifts, certainly outpacing inflation, Akiko, by quite a margin. And take a look at the company's results. It's privately owned, but they do release their annual results. Their profit margins went from 28% in 2019 all the way up to 35% in 2021. I would guess that they're still going to continue there to the upside, given the price of this bag.
Is it really about inflation? That's my question. I think part of this is about perception, right? Yeah. The Birkin was the exclusive up there. Chanel wants to get to that level. And to that point, there's a number here that kind of stood out to me in the Journal article. The Birkin's only 6% more than it was pre-pandemic level. So why is Chanel outpacing that? There's a number of ways to work that. You could limit the number of bags. You could raise the price a little more. I mean, to me, luxury is all about perception, and Chanel's trying to reach that Birkin level.
I just don't know if they can. I mean, the Birkin bag, that's like woven into pop culture references all over. I mean, but I think this is also a story about the strength and resiliency of the luxury consumer. They are willing to pay these higher prices despite inflation, despite these price hikes, whatever you want to call it. Now, this stat from the article stood out to me. The Chanel model was $4,000 cheaper pre-pandemic to the Birkin in the U.S. Now today, it's only $200 less. And the pandemic was not that long ago. So the fact that they're increasing these prices that dramatically is just crazy to me. I don't know if I could ever justify spending over 10 grand for a handbag.
I wish that this is a dilemma that I actually had, which of these bags to go for. Maybe one day, though. Kaz, you're a luxury guy.
Yesterday, you guys complained about the watches that I was talking about being too expensive. You guys don't want $10,000 handbags. My God. Well, I mean, I know the Birkin, even I know the Birkin, very, very popular. I did not know about this.
You're a fancy guy, makes sense.
Yeah, right. I did not know about this flat bag, but I'm not surprised about the relentless bid up in pricing, because I'm seeing that in the car world. The Rolls-Royce CEO told me, the Bentley CEO told me, they are charging more and more for their cars. People are paying for that, including customization, stuff that makes their products more unique. People want to pay more and more for that because they want to have that thing that stands out. And maybe, I don't know about this, but maybe there's some purses out there that will make you stand out in the crowd.
I think they're just trying to be a little bit more exclusive, Chanel. They want to rival Hermes Birkin's bag. I don't know if we'll get there, though.
I don't know. But in the meantime, the rich are just keep getting richer, I guess. Moving on to my story, it's Disney. The stock falling today about 2% on the heels of a fresh Wall Street downgrade. Macquarie analyst Tim Nolan downgraded shares to neutral from outperform, citing linear network declines, direct-to-consumer hurdles, and the slowing parks business. He sees those near-term uncertainties weighing on earnings, valuation, and sentiment, adding he's concerned about Disney's ability to reach streaming profitability by 2024, which is the company's current target. And part of that reason for that view is the likely purchase of Hulu from Comcast, which currently controls a third of the streamer, along with those sequential subscriber declines. And then ESPN, guys, that's just an issue lurking in the background. The Wall Street Journal reporting Disney is currently laying the groundwork for that over-the-top service, which Iger has said will happen, but analysts now are saying the process to get there is going to be incredibly bumpy.
You know, I want to just touch on quickly. We talked about ESPN yesterday, but the theme parks is very interesting to me in the sense that I read a tweet just now by Connor Senn at Bloomberg talking about how Disney built Epcot, Hollywood Studios, Typhoon Lagoon, Animal Kingdom, and California Adventure between 1982 and 2001, and they haven't built anything since the only big thing being the Star Wars theme park. So there's like
which they're closing.
Right, they're closing part of it. So there's a capacity sort of issue there. More people want to spend money on these types of vacations and experiential things, and there hasn't been that much build out. Las Vegas has only had one major casino built since 2010. There's actually a capacity issue when it comes to those types of vacations, and maybe Disney is there to sort of deliver that and also maybe charge higher prices.
Yeah, Ali, when you mentioned the streaming profitability, the timeline there, that's an interesting one for me to watch because so much of this is about an arms race. If Netflix says we're going to spend more, then of course Disney's going to match that. That's been where it's been going. Now we're starting to see a bit of a pullback in spending in content. And yet here we are talking about the crowded streaming landscape. At the end of the day, you do have to compete on content and you do have to put money up if you are trying to win out in that. So there's a bit of a balancing act. It feels like that's happening right now. That's not specific to Disney. But I'm curious, now that we are in this environment of a bit of a pullback, a bit of a slowdown, how the other streaming sites also respond, because at the end of the day, when you look down the line, you still want to be in a position of strength. And in order to be in that position, you've got to churn out content.
You got to turn on content, and you got to have the subscribers that are willing to pay for whatever you charge for your service. It will be interesting when we talk about the slowing economy right now, whether or not people are going to cut down on the number of subscriptions that they have, and who, of course, will then take the brunt of that. When it comes to the parks business, and Prowse, you brought that up here, it's amazing to me in this type of economy that people are spending, and they're spending as much as it costs to go and spend a weekend.
They're buying Birkin bags and they're going to Disney.
Bags and they're going to Disney for the weekend. I mean, that's what it sounds like, because it will set you back hundreds and hundreds of dollars per person.
That is ultimate luxury. If you're taking a Birkin bag to go to Disneyland, you're doing just fine. And that is the divide we're talking about. But I don't know. Maybe there are people that are doing that.
Their Star Wars hotel, what was it, $4,800 for a weekend for a couple? That's pretty high-end luxury to me.
Yeah.
That's a lot of money. That's a lot of money. We'll end it there. Let's talk about this other thing that I'm watching right now. Instagram, set to launch a text-based app that will compete directly with Twitter. And the app could be released as early as this summer. Now, according to details that were first released on the Substack newsletter, ICYMI, in case you missed it, the platform will allow users to post text updates of up to 500 characters. Users will be able to attach videos of up to 5 minutes long, and the app's going to be decentralized here. So it's going to be compatible with other apps like Mastodon. Bloomberg reports Meta is already testing the product with influencers and some creators. And we go back to where things were at the very beginning when Elon Musk bought Twitter. How many of those users moved away? I'm curious how many of those users now Meta, Instagram, can bring on board, because there are a lot of creators out there that are looking for a newer platform where they feel like it's a little safer. They feel like there's more of a discourse. I don't know. Is something you guys would try out?
Well, I think the safety features that they laid out, just in terms of you can regulate who is able to reply to you. You're able to control some of your followers. It's, features that are not available right now on Twitter. That's what I think could potentially set this service apart from what we have today on Twitter. But when you take a look at Twitter's user base, they've been struggling now for some time to continue to grow that user base. This could make sense, but you got to question what the future looks like for a service like this, for a platform, and how many people are actually going to leave Twitter and go there. I don't know. It makes sense from a creator's perspective, though, I think.
And they haven't figured out how to monetize yet. That's the big question on this new platform.
Exactly. And to me, the Twitter brand is just so strong. And we've seen other competitors try and come to market. They haven't been able to gain the same traction. You could also argue, though, that now is a good time to debut something, considering a lot of users are frustrated with all these changes under the leadership of Elon Musk. That's about to change soon. But one thing that stuck out to me was the character limit. I think 500 characters might be the sweet spot. Twitter's original character limit was 140. They doubled that in 2017 to 280. So that's something new. But yeah, to your point, I just don't know how they're going to be able to lure these users onto the platform. I guess it starts with the influencers. If you can get Gen Z, you can have access to a lot more people, but we'll see. I'm not fully convinced at this point. And do we need another social media service? Personally, I don't think so.
Well, I mean, what's the motto? Imitation is the most sincere form of flattery. Mm-hmm. And that's Zuckerberg's motto, right? I mean, he copies everything and makes it maybe better. I don't know. That's what when I saw the actual screenshots for the Instagram version of Twitter, it looked just like Twitter. I mean, it was almost exactly the same. And I have to ask myself, I like Instagram because I like the picture-oriented, image-oriented nature of it. I don't want to be I don't want to be writing, big 500-word essays and stuff like that. I think I wanted to use it mostly for images, but I could be wrong. Maybe like these more influencer people will come on there and maybe want to do more interaction in that way. Maybe Elon will turn off more people and will want to use Instagram for that tweeting nature. Anyway, for my take here, my roundtable pick, big news out of GM, the automaker announcing its Silverado EV work truck that's meant for fleet customers will now top out at 450 miles of range. That's an improvement over the 400-mile prior estimate. Great for fleet operators who value range over niceties like touchscreens and air suspension. But the range topper will set those back around $80,000, so not cheap there. But GM does say the cheapest Silverado EV work truck will come in around $41,000. So, but we won't know what the range is. So there is a cheap option there, probably around half, a bit more than half of range there. But it is interesting to see that this truck will have 100 miles more range than its nearest competitor, which is the F-150 Lightning or the Rivian with the large battery pack. So kind of a big deal here in that EV pickup space.
Yeah, I mean, range anxiety is a real thing, right? I mean, and especially, Praz, I'd be curious to get your thoughts here because anything over 300, I feel like is kind of the comfort zone for those who haven't necessarily gone all in on EVs. When you talk about trucks, you've got to go even more than that because you figure those who are currently driving ICE trucks are harder to convert over to the EV side.
Yeah, I mean, if you can, 300 miles has usually been considered like the psychological barrier of what people are willing to live with. 400 miles, 450 miles. I mean, people don't want to drive that much in a single day, let alone, a single trip, right? So what we're seeing is that could be the range that could help people out. But also in the future, you could see trucks with lower range, but the ability to fill it much faster, like in like gas station time. So that could be the future too. So we're going to see how that works out right now. But GM sort of kind of throwing down the gauntlet here with that 450 plus mile range.
Yeah, certainly. I think a lot of the talk here ahead of this news was that Chevy was late to this when it comes to the Silverado, given the fact that the F-150 Lightning has been out now for quite some time. But it might have been worth the wait, given the fact that a lot of people, like you guys are saying, range anxiety is such a huge thing. And the fact that you could get 450 miles here before you have to recharge is certainly a differentiating factor. I am curious, though, what the growth trajectory looks like when it comes to EV pickup trucks, because I'm with you, Akiko. I would think the pickup driver would be one of the last to convert to EVs, but maybe I'm wrong.
I'd agree with that. I mean, to me, I'm not a car person, but I understand the importance of mileage and of these fleets, especially when you're talking about commercial industries. So I guess we'll have to see, but it's certainly a hotly competitive market. So it doesn't surprise me.
Yeah, exactly. And Ford's having a tough time keeping up with their reservations, so maybe they'll prove us all wrong. All right, well, coming up, we are counting down to the closing bell on Wall Street. Again, losses across the board for today. The Dow off 88 points. We'll be right back.
And there you have it, the closing bell, rounding out what was another toppy week here on Wall Street right now. Let's take a look at where the majors closed the day. The Dow down 111 points, the S&P 500 down 6, and the Nasdaq down 30, though. Major averages, though, seeing some weekly gains here, and certainly a positive when you consider all the concerns that have been percolated through the market. You know, Shauna, we were talking earlier today about the comments that we got from Fed Chair Jay Powell, essentially implying that those interest rates may not have to rise as much given some of what we've seen play out in terms of the banks. But today, it certainly felt like it was the debt ceiling that really drove things to the downside.
It certainly was the debt ceiling. We saw that reflected in the intraday moves here after the debt ceiling talks hit a standstill. That had certainly put pressure on stocks. Congressman Garrett Graves, who Speaker Kevin McCarthy has tapped to lead the talks, telling reporters, quote, "It's time to press pause because it's just not productive." President Biden is in Japan at the G7 summit. Confidence, though, that a deal will be reached by the X date is waning. We're seeing that reflected in the market action today. When we talk about the degree that this is going to impact the markets, that is what is up for debate. Obviously, it's a very serious situation. We've heard a number of economists warn of a doomsday type of scenario. And Akiko, UBS was out with a note today saying that we'll probably drop about 20% in the S&P if we do, in fact, see a default.
Now, of course, the president over in Japan, but before his trip over there, it did feel like things were moving in the right direction when you think about what we heard from Speaker McCarthy saying that he doesn't believe the U.S. is going to default on its debt. The president saying there was some progress there. So today, seeing this pause from the GOP, certainly raising questions about where we are as we get closer to the X date. And a reminder here, we're talking about June 1st, so just a few weeks out. Another major headline moving markets today, Morgan Stanley CEO James Gorman announcing he will step down within the next 12 months. Gorman is one of the longest serving heads of a U.S. bank. And once a successor is installed, he'll move to executive chairman for a period of time to help with the transition. And Shauna, when you look at the move we saw in Morgan Stanley's stock today, that really points to the influence and the way in which investors have looked to James Gorman here. The stock down about 2.5% or just over that. He has been sort of the face of stability within the banking sector since he's taken the helm in 2010. So it will be really interesting to see who that successor is going to be, because especially in this environment, you know, we have seen any kind of headline really moving. We're talking about big banks, not regional banks, but still, James Gorman, when you think about where he has been that face of stability within the sector.
Yeah, certainly. You can see the jitters there from investors just on the news of this, even though it's not expected to happen for several months. When we talk about who could potentially succeed him, there's 3 names that are being looked at right now. But James Gorman, like you said there, Akiko, has really transformed the bank, turning it in to a leader in the wealth management space. When you take a look at some of the strategic acquisitions that he has made over the last several years, including E-Trade, including Eaton Vance, clearly boosting that side of the business. It accounts for about 45% of the revenue in its most recent quarter. So Morgan Stanley, without James Gorman, I think investors are a little bit nervous for exactly what that could maybe look like. Also, another big mover today, and that is Deere. The stock closing the day in the red here, off just about 2%. The maker of tractors and other farming equipment upping its profit outlook for the fiscal year. Also beat the street's estimates for both revenue and earnings. But we did see Deere shares give up some of the earlier gains here after there were some concerns out there on the street that maybe the performance that we are seeing could be as good as it gets, and we'll potentially see a decline as we look out to the remainder of the year.
Yeah, I mean, this is one of those bellwethers that we look to in terms of, you know, especially within the sector where things are moving. If you look at the broader slowdown, the fact that they raised their guidance, certainly a promising sign, but interesting to see where the stock moved today on the back of some of those announcements.
Yeah, certainly closing off nearly 2%. All right, let's recap some of the biggest movers of the week, all 3 of the major averages. It looks like eking out gains for the week, and Nesfarai has a closer look for us.
Yeah, Shauna, and as you mentioned, the Dow up for the week, just slightly though. The Nasdaq definitely the outperformer for the week. I'm going to pull up our Wi-Fi interactive so you can see up 3% for the week, and the S&P 500 up more than 1.5%. Now, technology has really led the gains this week. And if I pull up a 5-day chart on our sectors, you can see technology up 4.3% and communication services as well. Over on the Nasdaq 100, tech heavy. You can see the left-hand side of the screen, the big cap names gaining for the week. Amazon up more than 5%. You've got Alphabet up more than 4%. The chips did very well this week. NVIDIA up 10%. Tesla, which had its shareholder meeting earlier this week, up 7% for the week. I do want to point out what has happened with the retailers. I know there's been a lot of talk about the retailers, but I want to point out what the divergence that we've seen. This is a 5-day chart right here. So just want to point out the divergence that we've seen when it comes to Walmart and then when it comes to Target, because we had Walmart earlier this week, which reported, I'm going to pull up a year-to-date chart so you can see Walmart has really been benefiting from this environment. Both companies really talking about the consumer being a little bit more strained, but Walmart is seen as a stronger player because of its price point. It's also seen as a stronger player because of its grocery unit, which is stronger than Target's. And so you have seen a divergence when it comes to the stock, or at least an outperformance, I should say, when it comes to the stock year to date with Walmart versus Target. You can see here it's up 5.7% year to date, Target up 2%. And then a 1-year chart will show you that Walmart is up 25%, while Target is relatively flat over the last year. And then finally, something that's been happening, or today we saw session lows for the regional banks. And this is very important because this came after a report from CNN that Treasury Secretary Janet Yellen had told bankers that more mergers may be necessary. Now, we've seen the turmoil with the regional banks come in waves. If I pull up a 5-day chart, you are still seeing big gains for the regional over the last 5 days. But today, you did see some pressure on these banks over the prospect, perhaps, of more turmoil ahead, guys.
Yellen comments certainly moving bank stocks today. Nesfray, thanks.
Well, let's take a look back at how the broader markets fared this week with Ken Mahoney, Mahoney Asset Management CEO. Ken, Annette's just giving us a roundup here of what we heard from the big retailers that reported this week. Yes, the consumer is cautious, and we are seeing trade downs, but if you are in a position like Walmart, a little more diversified, a little more leaning towards groceries, you can still perform strongly in this environment. What are the comments that stood out to you?
Yeah, I also think in addition to groceries, and I think they've done really well there, bring unit costs down because, they get a great economies of scale. That's what Walmart's all about. But, they're doing pretty well online. I mean, Amazon is the monster there, obviously, and they're just kind of picking away a little market share. Look, Amazon user, which I am and others are, it's getting more and more expensive. And Walmart seemingly has some better prices than that online. So it's definitely going to be more like a war with the apps between Walmart and Amazon. And I think little by little, Walmart's getting more market share. And I think that's pretty constructive for the company.
Ken, GOP lawmakers walking out of the debt talks today, that was a big mover in today's action. When we look ahead to next week, the uncertainty that lies ahead, how are you looking at that from an investment perspective? How big of a threat is it?
Right. And I know you said at the top of the hour there, but, I have to tell you, if they really thought that we're going to default on our debt, I think that Dow would probably be down 800 points, 1,200 points, God knows. I think it's just, a little hedging here. We've had a strong week. Some of the chips got ahead of themselves in the video, some great names have done really well. So I just think it's just, taking some chips off the table. I don't really think we're going to, and I don't think anyone believes we're going to go default debt. Remember back in 2011, by the way, the S&P 500 lost some 17% about a 6-week period. I think they kicked the can down the road, give them time to breathe a little bit, and they'll still do something in the 11th hour. So that's my kind of bet right now, is they'll kick the can, try to, pay off, and then maybe sometime September resume this. That's my guess here.
What we heard from Jay Powell today, the fact that rates may not have to rise as high because of some of the jitters that we are seeing, especially in the banking sector. I mean, did that change anything for you when you think about investing around potential Fed policy and what this could mean for the June meeting? Does that change your
Well, it
base
means a
case
lot.
in any
Like
way?
I like to think of and telling clients we believe we're in the ninth inning of rate hikes. You know, Powell may throw an extra innings in there, but doesn't really have enough ammo to go to June. I think we're going to be in a longer pause. I mean, there's a lot of talk about Fed fund futures, and later this year they're going to cut. I don't see that. We kind of see this 5.25 Fed fund rate, and maybe staying on for quite some time. Remember, the Federal Reserve was going to raise rates until something breaks, and some things were broken, starting off with Silicon Bank and some other banks. So I think really at the moment, you know, most people are like, okay, the worst is behind us, 10 rate hikes in a row. Going forward, maybe one more hike, and we could kind of live with that at this point.
All right, Ken, we need to take a quick break. We want you to stick around, though. On the other side, we're talking a few stocks that you should buy, a few to avoid. We've got all of that for you when we come back. Markets have been on a roller coaster this week with retail earnings, Fed talk, debt limit negotiations. Those have been the big drivers of action. Let's talk about how to play this. Ken Mahoney is back here with us, Mahoney Asset Management CEO. Ken, so let's start with your two buys. We know certainly tech has been the outperformer since the start of the year. You've got two picks in this space. First up, NVIDIA. I thought this was a bit surprising given the run-up that we've seen over 100% since January 1st. What's going to keep this momentum to the upside?
Yeah, look, the earnings come out next Wednesday, the 24th. Again, I don't have a peek at them, but I think the market's getting behind on the earnings. I mean, this reminds me of that kind of hockey stick growth that we saw with Tesla a few years ago, that valuations matter, but they don't if they're going to grow the top line. AI is a big thing. This is going to dominate. Before I said, hey, Fed funds and all that's probably the ninth inning. Well, for AI, we're probably more in the second inning, just the beginning of the cycle. Hey, it will have its ups and downs. Recognize the stock is going to parabolic. The tactics that we kind of use is kind of buy and hold maybe a half to 2/3, and maybe trade around it, sell some calls and so on. But at the end of the day, this is where the leadership's going to be. And I still believe there's a lot more upside with NVIDIA throughout the rest of the year, even though the stock's already doubled this year.
Yeah, I can't think about how many times we heard AI in earnings calls, but when you think about those who have been leading, obviously NVIDIA with the chips, Microsoft's certainly been a big leader on that front. You know, it's interesting, we heard from Meta this week talking about having to own the entire stack. to be able to scale AI and win in this space. How does Microsoft present an opportunity for you in terms of that and the competition that is just gearing up right now?
Look, Microsoft, thankfully, is not a one-trick pony, right? So it has everything from gaming, all the different verticals, from cloud to all the different software. You can't go without software with Microsoft. And then in addition to that will be AI. And if you look at Microsoft the last few quarters, they beat earnings and they raised guidance. Those same thing for on the video. So these are the companies you always want to look for. Those companies that can beat estimates, raise guidance. I think Microsoft's going to take a little chunk out of the dominant space for Google search. Even a small market share goes in the right direction, and you get all those many verticals with Microsoft.
Ken, more broadly speaking, though, when you take a look at the run-up in the tech sector, there was a Bank of America fund manager survey out earlier this week talking about how being long tech is one of the most crowded trades right now. Why aren't you worried about those valuations?
Right. So, everybody complains about being narrow leadership. And it is. I mean, that's just the hand that we dealt with this year. I mean, this is a kind of a bull market and a bear market. Pretty much, the Dow's unchanged for the year, and Nasdaq's up 20%. You can go and hide in PEs of 6%, 6 or PEs of 8, it seems, and they'll still be trading there. Yes, you're paying a higher multiple, but you're getting a higher growth rate. And to me, if it's going to be narrow leadership, be with the narrow leadership. If it's not going to spread out, it's not going to have strong breadth the way it's been shown. Stick with the leaders. I mean, that's kind of how we've been trained. Look at the best industry, the best stocks in those industry. Yes, they'll be volatile, but you're going to be more than compensated for that volatility.
Let's talk about the other two stocks that you've pointed out to avoid. And I want to talk about KRE. This is an ETF for the regional banking sector because, yes, we have seen just the volatility there. It feels like there's starting to be a bit of a differentiation between the regional banks. Is it your sense here that we've hit the bottom, or do you think there's still more cracks to come when you're looking at some of the other names in the space?
I think there are more cracks to come. The reason I picked out KRE and that's selective, let's say, banks, is that if you wake up one morning like PacWest or some others and they're down 10%, you go to CRE, next thing they're down 6%. They go down in sympathy. So I just think there's better other opportunities. As I mentioned, AI is all the rage for all the reasons. There's other pockets of strength, semiconductors, of course. So to be in this space, regionals, you're going to have to have strong stuff. And it's really hard to pick through what's going to make out the other side, which ones are in trouble. But every time there's a problem with just one of them, it comes back and hurts the region. I think you said earlier, for the week, Free had a good week, but you saw it close at the low of the day. And I think still there could be a couple of ones out there, and they always take it out in this ETF, it seems.
Ken, the other pick that you suggest that people avoid is Anheuser-Busch. We know that a lot of people have been closely watching the sales of Bud Light, given the controversy and what has happened over the last several weeks. Do you think there's more downside risk ahead, it sounds like?
Yeah, it could bounce a little bit. I mean, it's gone down so hard. I mean, it was in a high 60 before the controversy started. Below 60, I think it landed sub 60. It could bounce a little bit. It could be a short there. The sales numbers are pretty amazing. 20-something% week over week. I didn't know it was going to be so sticky, but it is very sticky. And it looks very tempting. Say, hey, the stock was 70, and because of the controversy, that will blow over. I'm not so sure it's going to blow over that quickly. It still remains sticky, and therefore, we would avoid that stock. As tempting as it may look, being down so much in the last couple of weeks.
Ken Mahoney, Mahoney Asset Management CEO. Good to have you on this Friday.
Great, thank you. Have a great weekend.
Well, coming up, debt ceiling negotiators hitting pause on their talks. We're going to discuss the latest with James Carville on the other side.
Debt ceiling negotiators hitting the pause on their talks, raising new concerns about whether a deal will be reached this week. And a White House official telling Yahoo Finance there are, quote, real differences between the parties on budget issues and talks are going to be difficult. Joining us now is Democratic strategist James Carville, who is host of Politics War Room with James Carville and Al Hunt. James, it's good to see you here. So when President Biden left for G7, he was optimistic, confident that a deal would be reached this weekend. It sounds like now things might be further apart. The talks might be further apart than we had initially thought. Where do we go from here?
Well, they're going to obviously get back and start talking again. And I don't like the term debt limit. It's about a default. That's what we're talking about. Let's don't sugarcoat this. If they don't do this, the United States is going to default on its debt. That's just a fact. And we got to quit. We got to start talking directly here. And it's not surprising the Republicans don't know what they want. They haven't even submitted a budget yet. And they've been in power since January the 3rd. President Biden submitted his budget. So it's going to be some tough sledding here. I don't think there's any doubt about it. I'm hopeful that they'll get back to the table and avoid this catastrophic outcome. But who knows with these people?
It was just a few days ago that we heard from House Speaker Kevin McCarthy saying that he did not expect the U.S. to default on its debt. What changed since then? And how much of this is about pressure coming from the more conservative wing of the party and the House Freedom Caucus?
Well, understand there's also pressure on the White House negotiating from some Democrats to say that all you want, all of the things that they're proposing are things that are important to a lot of Democrats. So there's pressure everywhere. I mean, this is a high pressure thing, and the Freedom Caucus is having a lot of pressure, but a lot of Democrats are telling the White House, don't cave, don't do this. And it's a difficult negotiation. There's no doubt about that. And but it's highly critical. It's important. The financial markets, it seems to me, are going to react horribly if they don't come up with a solution to this. But I'm hardly a financial market guy. But in the political market, we need to communicate much more effectively and talk about default, talk about there's no budget, talk about the fact that in all the entire United States budget debt we owe, $31 trillion, 25% of that was accumulated in the 4 years of the administration of Donald J. Trump. And we do not tell people that. Our communications effort to this point has been negligible. And that's why we're in this shape we're in right now.
James, who do you think has the upper hand in this situation right now, given the timeline, looking out to 2024, President Biden running again? Because both sides of the aisle, members of both sides of the aisle have said that conditions need to be made in order to get a deal.
Well, honestly, the Democrats are winning every election you see. We're winning in Pennsylvania, we're winning in Florida, we're winning in Wisconsin. So the Republicans, I'm sure, understand this, and they need to change their trajectory that they're on. And I think they see this as some kind of a potential advantage for them. And if we have this what people that I know and trust and think their judgment is good, if we have this catastrophic outcome, they're hoping that Biden suffers from it. But right now, they're having a terrible time electorally, and believe you me, they know it. So I think they view that if there is some horrible economic outcome, it will hurt Biden more than them, but it'll hurt the country more than hurt anyone. But that's just where we are with the modern Republican Party, and who knows that they might do anything. I'm not totally confident that they'll come around and do what's in the interest of the United States. I hope I'm wrong.
So what's the political calculation on the Democratic side then?
Well, there's two political calculations. One is, let's just keep this economic recovery going. I mean, this is the lowest unemployment we've had in 50 years. You got more people working, incomes are going up. You got more great percentage of people that have health insurance now than ever before. And if we just keep this recovery going, we'll be in good shape. The Republicans see that, and they say it's to our advantage to mess up this economy, to throw a wrench into it. And then people are inevitably to blame President Biden. The side that has the best, most effective, most disciplined, most enforced communications is the side that's going to do better here. But it's not clear. I'll be honest with you. They think they can damage the United States and damage in the process of damaging the United States, they could damage Joe Biden. And they might be right. I'm not here to tell you that they're totally wrong.
James, you just highlighted a number of positives for the economy, particularly within the labor market. And yet when you look at the president's approval rating, they don't look good. What do you think's the issue here? Is it about messaging from the White House?
We had a pretty good economy in '94 and we got beat bad. The President Obama had brought, GM was back and they had a terrible 2010. I mean, I can't describe what people's lives are like or why they have certain opinions, but by every objective opinion, every objective measure, I should say, this economy and this job market is strong as garlic in a milkshake. I mean, I don't know how it could be any stronger than it is. And, when that takes over, people realize that. I don't know. It's a great unanswered question. And even in cost, I don't like the word inflation. I like the term cost of living. Even the cost of living is starting to level off a little bit. But when that takes hold in public opinion, I can't tell you. I don't know. It's very scary. But right now, what I'm scared to death about is we got to get through this this default fiasco. The United States becomes a deadbeat nation. And remember what happened in 2011? We lost something off our credit rating, and it cost us, I don't know, hundreds of billions of dollars. It's an expensive game that they're playing.
So, James, what should the message then be from the Biden administration as we look forward to 2024? Because you mentioned the fact that the economy is quite strong. It's been quite strong for some time. It has not been resonating with voters now over the last couple of years, unlikely maybe to at this point going forward. So what should then the focus be if the economy is not it?
Well, first of all, right now, between now and June the 1st, or whenever we run out, it's to default or not to default. And if you want to have constructive talks, do your constitutional duty and submit your budget. I mean, that's got to be the message between now and the end of the month. The larger message is that, we're working hard and, if we keep this economy going, people will feel the effects of it. But right now they're voting Democratic out there. I mean, maybe they don't like the economy to give the president low ratings, but we win in every election that we're in. And that's everybody looks at GDP numbers. Everybody looks at the polling numbers. Everybody looks at the press coverage. I look at the election returns because I think that people voting is the most consequential thing that happens in politics. And I got to tell you, what I'm seeing so far is pretty doggone good. And I think that Kevin McCarthy and them are looking at the same numbers and said, we got to mess this thing up. We're going in the wrong direction. But I can't give people why they feel bad about one thing or another. I guess one of the reasons they feel bad because the financial press keeps telling them that we're getting ready to go into a recession. If I listen to financial press, I think we're all doomed. And of course, we're not any remotely in a recession right now. Maybe all of y'all will be right and we collapse next month. But right now we haven't. We went in elections.
James, you're the big strategy guy when it comes to campaigns. And I'm curious to get your take on what's playing out on the GOP side. When you look at 2024, there's obviously Florida Governor Ron DeSantis. We heard from South Carolina Senator Tim Scott today, putting his hat in the ring for a presidential run. And then you've got Donald Trump still out there. If you put your strategy hat on, who do you think poses the biggest threat to President Biden right now?
I don't know, but they are literally destroying each other. In DeSantis, one thing in politics, you have enemies that you have to have. The enemy's a necessity. So your candidate wants the office, somebody else holds it. That's your natural enemy. You have an office, your opponent wants it. That's your natural enemy. DeSantis is making terrible enemies of choice. It's a terrible enemy of choice to go after Disney, a huge, sophisticated corporation that is the largest private employer in the state of Florida. They have gone after, there was this wonderful story in Politico, they've gone after his chief strategist, a woman by the name of Susie Wiles, at the behest of Mrs. DeSantis, and they're cutting him up one side, down the other. So I would say this going forward. DeSantis doesn't have very good judgment in picking his enemies of choice. Trump is his enemy of necessity, but he's not doing that well right now, and they're gonna keep jumping on him like mad. And from just a political guy watching this unfold, you're like, come on here, guy, you ain't playing this game very well. I mean, sure they can get better, but they're not very good right now.
I imagine you might make a call there. We'll see. James Carville.
I'm having too much fun watching. I'm terrified by the death of it, but I'm having fun watching these Republicans. I mean, this is really a lot of fun. It's like watching LSU win a big football game.
I imagine you've got your LSU shirt on there. James Carville, as always, thanks so much for joining us today.
Thank you. I always love being on this network. Thank you. Thank you.
Coming up, we are joined by the CEO of Tanger Outlets, Stephen Yalof, for a vibe check in the retail sector. Stick around.
We've been tracking the state of the consumer all week on Yahoo Finance. And as we've heard, CEOs are raising some caution about how shoppers are spending their money, especially trading down. And that trend could be good news here for our next guest. Joining us now, we want to bring in Tanger Outlets CEO Stephen Yalof. Stephen, it's great to see you here. So that has been a theme, consumers trading down. I would imagine that that's probably good for your business. What are you seeing?
Well, again, the shopper is there, but they're definitely looking for value, and that's what you get when you shop in our shopping centers every day. We are a value platform, but for brands that people seek. So we're not selling commodity-priced goods at the cheapest price. We're selling great international and national brands every day at the best possible pricing, and the customers are seeking that, and we're meeting them where they are.
Yeah, I mean, what have you seen anecdotally in terms of foot traffic, in terms of bringing new consumers on board? Because to Shauna's point, we heard from so many of these retailers saying we're seeing higher end consumers trade down. We're also seeing additional like consumers that are maybe on the lower end mixing up what exactly they're purchasing, not as much for discretionary items. I mean, give me an anecdote of what specifically you're viewing in your outlet.
Yeah, well, first of all, in general, I think the retailers that are winning are the ones that are discounting deepest, and that's in the apparel. We're seeing the same thing in accessories. If you're an accessory retailer and you're discounting right now, you're seeing a lot of customer traffic in your shopping center, in your stores. Similarly, in the athletic brands, we heard the news about Foot Locker today. But what we're seeing is slightly different. We have Nike stores, Adidas stores, Puma stores, and where they're offering the consumer those famous brands that they love at the best possible price, we're seeing the customer respond and shop there.
Stephen, I'm taking a look at your investor presentation today. 96.5% occupancy levels. Pretty impressive given this environment. We certainly have seen the rebound in retail. What do you think the growth trajectory then looks like here from here on out, given the fact that how consumers are shopping continues to change?
Well, first of all, we'll be going to ICSC. That's the council, the shopping center council. Meetings will be held in Las Vegas this week. And from what I understand, it will be probably the best attended ICSC in years, meaning the retailers are out in force and the developers are there. We're meeting with them on a regular basis. They're coming in with open to buys and looking to build their store counts in our portfolio. There's a number of retailers, we had a discussion about this morning, a number of retailers in our portfolio who had been on the sidelines for the past 2 or 3 years that are now very actively pursuing building their stores, particularly in the outlet space, because that's where they see the consumer coming to shop.
Stephen, you were running through some of the brands that you've seen do particularly well when you think about your outlets, but we've also heard about the shift over and over from goods to services, that services are where consumers are willing to spend the money or the additional money that they do have. Are you seeing that shift?
We are, and I think that that's a trend that we've seen for the last, I would say, 2 or 3 years. Folks traditionally would come to an outlet center to shop, and they're looking for that power shopping experience, great brands, great value. But what we're finding is that they're staying for lunch, and they're staying for meals, and they're staying for entertainment. And we're providing all of those uses in our centers as well. In fact, the sign went up yesterday in San Marcos, Texas for our first Shake Shack. So we're excited to bring that into the market. We're under construction across our portfolio right now for 2 Dave & Buster's, because we think that there's a customer who wants to come and do something other than shop when they're in an open air environment like a Tanger shopping center. And we want to bring them those uses as well.
When it comes to the rents, what you're able to charge here, is that consistently increasing? And do you see that trend sticking?
Well, yeah, we reported in our last quarter that our rent spreads, which is the indication of how much more rent we're getting from the previous tenant, they continue to go up. And we've grown our rent spreads for 8 consecutive quarters now, and the last quarter being the highest growth that we've seen so far.
Is it the case across regionally speaking as well, or are you seeing strength in certain areas?
Well, I would say the stronger demographic and the stronger market that we're seeing right now is in the South. But I think a lot of that will pivot now that the summer months are coming to the north. We're primarily an East Coast shopping center company. We do have centers in Texas, and we do have one center in Arizona, which happens to be one of our best performing centers in our portfolio right now.
All right, Stephen Yellow, the CEO of Tanger Outlets. Thanks so much.
Thank you for having me.
Well, Toyota is taking the wraps off its revamped Tacoma as the midsize pickup space grows even more competitive. Yahoo Finance's senior autos reporter, Pras Subramanian, back with us with the details. Prasa, what's new about this Tacoma?
Pretty much everything. The new Taco getting a makeover, as it's known amongst fans of the truck. Basically, this truck has been around for 20 years. I can't believe it. It's only had one little minor refresh. So it really needs to be done as the competition really heats up in space. So new bodywork, of course, new chassis, different powertrains there. Long gone is this old V6 that's been around there for a while. New turbocharged 4s, including a mild hybrid that gives it enough power to sort of challenge the Rangers and also the Chevy Colorados and GMC Canyons of the kind of the landscape there. So a big move there for the Tacoma. It is the #1 selling midsize pickup in America by a long shot. So I see Toyota wanting to do that now. They need to do that now. Need to get kind of up to speed as these new competition kind of comes to the field right now. And of course, it all happens in the backdrop of the EV transformation. We just spoke about that, about the Chevy Silverado EV work truck. We have the Ford, we have the Chevy Silverado, we have the Rivian all coming on board. So this is all happening on the backdrop of a very competitive mid-size gas-powered space that will eventually become EV pickups as well.
Yeah, a lot of changes there, but to your point, an increasingly crowded space. Pras, thanks so much for that.
Gary Vaynerchuk hosting his annual VCon. It's a multi-day conference with leaders in Web3, business, and pop culture. Gary joined Diane King Hall earlier today on Yahoo Finance to discuss the conference as well as consumer behaviors. Take a listen.
we're building on something I've been doing for 15 years, which is practical positivity, right? Positivity, optimism matters, but you can't be delusional, and operations matter, and the results matter, and merit matters. And I think that's the blend that we've got here. So yesterday was phenomenal. The weather was great in Indy, thank God. Thousands and thousands and thousands of people on a field day doing different events. And the lineup is just outrageous of the 130 speakers that we have at the conference over the next 2 days here in the stadium at Lucas Oil. So far, so good.
All right. I want to ask you really quickly about Twitter. As I mentioned, I follow you on Twitter. Twitter has new leadership coming in, recently announced this week. Over at the WPP, they said Twitter no longer is high risk after this new chief is appointed. What's your thought about Twitter now?
It hasn't really changed. I really didn't see Twitter as a high risk for advertisers based on consumer behavior. Obviously, some people that are writing the checks may not like or agree with things that Elon does, and then thus rendering them not wanting to advertise. But obviously, Linda comes in with as much equity in ad land as there can be. And she's been a remarkable innovator and executive in the traditional media space. And now what she's done for championing brands spending money on TV commercials, she'll be doing for Twitter. And she was highly effective in her old role. And to WPP's stance, I fully agree. There's not going to be a single brand that's going to be concerned to spend on that platform. So from that standpoint, I think it's a win. And that's how I see it.
All right. And I want to talk to you about another social media platform, TikTok. We had news out this week that Montana is applying a ban on TikTok. What does that signal to you about the status of TikTok in America?
A little bit above my pay grade, because really what we're talking about here is states or the government, the federal government, deciding that an app that is owned by a Chinese company is got so much information that's detrimental to our society. It's impossible for me to speak on that, given that I don't see what they see. What I know is that I am not overly emotional about any platform. When Vine is hot, I'm marketing there. When Facebook's hot, I'm marketing there. It's kind of like running commercials on Seinfeld. When it's the #1 TV show, you run ads. When it's not there anymore, you run it somewhere else. So attention will ebb and flow. But to answer you directly, it's just, we're talking about banning something because they're spying on us. That's a much bigger thing than marketing.
I understand, Gary, and I know you're saying it's above your pay grade, but I don't think it is, in the sense that you really have your finger on the pulse of just social media in general and connecting with people in general using a variety of platforms. And I think you've talked before about really not putting all your eggs in one basket, because think about once upon a time, MySpace was kind of the OG. Right?
Yeah, from that standpoint, the biggest issue of 3 years ago was I was yelling at people to go on TikTok, but they were cozy on Instagram, and then they regretted not doing it because they lost their relevancy. To your point, if TikTok was to be banned in America, that attention goes somewhere else. Is that going to be Instagram? I'm not so sold, because the form of content that needs to be successful, I would argue that YouTube Shorts feels extremely native. People are not paying attention to what's happening on Facebook Reels right now. A lot of marketers, especially the youngsters that are watching this, don't even have a Facebook. Meanwhile, Facebook Reels right now is one of the best underpriced attention places for the brands that are watching this show right now. So yeah, from that standpoint, I've got lots of thoughts.
All right. And it's so funny, to your point, they talked about that in their recent earnings call. Mark Zuckerberg talked about the Reels and how they're taking off, and they haven't really figured out how to monetize that aspect of the business, because it's hard to, I guess, integrate the ads within the Reels.
Well, and for everyone who's listening, especially this kind of audience, that means there's still opportunity to get organic reach. So while platforms have something explode from attention and they haven't thrown their full ad capabilities against it, what is happening there is an opportunity for your videos to get more reach. And that's something every small business and big business should be paying attention to.
That was Gary Vaynerchuk speaking to our very own Diane Inghall. Well, coming up, we round out the day and get you set for what to watch next week. We'll be right back.
Another sign that the IPO market might be warming up. Mediterranean fast casual chain Cava is filing to go public. It plans to trade on the New York Stock Exchange under the ticker CAVA. Very convenient there for them. The company revealing that it still is not profitable, but it did see its revenue rise nearly 13% to $564 million last year. The filing also showing same-store sales soared nearly 30% in the first quarter. Akiko, this is welcome news here for the market. We know the IPO market has been very slow. A number of companies staying on the sideline just given the volatility, given the higher rate environment, given the stress that we've seen in the banking sector. So maybe we're starting to see some signs of life.
Yeah, and this is certainly going to test the appetite of the market, no pun intended there. But when you think about where IPOs have been, I mean, we're talking about a near drought in 2022. Activity has started to pick up this year. With restaurants, though, we haven't had one in a while. And it's interesting to see, well, it'll be interesting to see, I should say, how Cava performs, because when you think about the sweet spot in restaurants right now, when customers are pinched, this might be it. When you think about how Sweetgreen has performed, others like Chipotle as well, shown relative strength here, even in the face of inflation. So we'll be watching that one really closely. Well, former two-time NBA champion Kenny Smith's new memoir, Talk of Champions, does a deeper dive into the people who have shaped his life. He joined Yahoo Finance's Brad Smith for a one-on-one to discuss the book, as well as his outlook on young athletes investing. Take a listen.
Before, I think players were looking to invest in businesses, or most of the time, early on in our careers, were trying to figure out how to manage certain things. Now they are the business, and there are very few businesses who can say, "Well, we were profitable $50 million this year." Like, there are very few businesses in the world that could say that. So, as an individual, when you have someone who says, "I was profitable for $50 million or more this year," they are the business. And it's how to attain themselves and continue that. And then what to invest in a profitable business instead of a business that's trying to be a startup.
Absolutely. I wonder how much of the talk, because we see the talk that's on there. You're talking about, of course, right now, the playoffs leading up to the championship and the NBA finals as well. But, off studio, are you guys talking about your business investments? I mean, we have spoken with CEOs of some of the companies that we know. Shaq has served on the board of directors at. We were just talking to Papa John's last week or a couple weeks back. How often are you guys feeding each other just information about your own kind of investment strategy or the businesses that you are looking to work with?
Yeah, I think you hit it right on the head with Shaq. Most people see me pushing him in a Christmas tree and say, "Man, that was so funny." But I think for overall, we have all the time business conversations, and I wrote this in the book about how Shaq and I, we were having a conversation, and I said, "Shaq, do you feel like at times you're oversaturating yourself? You have a lot of commercials, you're overplay." He says, "Well, Kenny, I'm in not the NBA anymore. There's a certain window of opportunity that's going to be available and open for me." And I said, "Yeah, but what about all your endorsements?" He stopped me right there. He said, "No, I never look at them as endorsements, Kenny. I look at them as partnerships. So our partnerships, then I'm going to do for them certain things that I wouldn't do for other people, and vice versa. And in those partnerships, we learn certain things." He also has what he says, "I have a Shaq Summit where all of my partners come together and then they learn about each other." So right then, my business acumen picked up years ago. And from that point on, I became a better businessman.
That's amazing. I mean, look, move over Warren Buffett's annual shareholder meeting and introduce now Shaq Summit, where perhaps that will get some more of the coverage here on an investment and kind of business profile basis as well. And you guys have an amazing team over there. Of course, people see that day in, day out, night in, night out with Ernie, Charles, yourself, Shaq as well. I'll give a shout out to Slice, who's like a brother to me. Even as you think about this next wave of where NBA content is consumed, how it's consumed, and how viewers are able to engage with it. What is the sports storytelling in streaming that you would like to see be more emphasized?
Well, I think right now, again, that there are very few people in the world. Elon Musk, let's say, is a billionaire. However, he's also, if you separately, he's the face of the company. Each individual, LeBron James, that's in the playoffs now, Joker from Denver, you have Jimmy Butler from the Miami Heat. They're the faces of multi-billion-dollar companies. So what they do affects every aspect of the company. And so on and off the court, which most people don't realize when they say, "Oh, this guy should be able to do this or do that," not realizing and never have been the face of a multi-billion-dollar organization. Then you think of a guy like Joel Embiid, who won the MVP. Now he's the face of the NBA, a $1 trillion organization. So very few people realize that these young men are faces of multi-billion-dollar and trillion-dollar companies, and they have to act and move accordingly because everything they do on and off the court affects the bottom line for the whole business, not just them as an individual. They think that it's, their playing time, their thing. No, it's multi and trillion-dollar industries that are being affected by every move that they make.
How can players that are trying to get to the league make sure that they are capitalizing on the business of their name, their image, their likeness, even before they step foot on an NBA or a professional level court, knowing that, careers can take wild turns at the end of the day. And we got a fresh new talent and prospect, Wemby, that's coming in, who's got a ton of fanfare around him right now.
Well, Wemby has an ability because he's the first global superstar initially. Like most players come in and are known, like LeBron James, he was known 100% here in America. Wemby's known worldwide first. And that is a unique position. So Wembanyama has an unbelievable access to, people in France and in Europe that LeBron James had to grow and get. So his ability is going to be much different. I think coming in, you've already been a leader of men and young men in your life. So I think that if you realize that you continue that attribute, those are the same qualities that CEOs look for. I have an AAU team at one time. I was coaching a 5th grade team, and the mom is screaming at me. She's like, "My son should be playing more." I'm like, "Well, I'm not going to talk basketball with you. I'm not going to argue basketball. However, your son, I put in charge of getting the team ready to play, the stretch, on the layup line, what to do. And every time that John says one thing, 12 other kids move. Do you want me to take that quality away from him, which CEOs of every company want? so I could give them 3 extra minutes on a basketball court? Or do you want them to have the qualities that could actually own a basketball team? He said, Kenny, I'm sorry.
NBA great Kenny Smith there speaking to our very own Brad Smith. Well, it is closing time here at Yahoo Finance. Let's get you ready for the week ahead. First up, we are getting quite a lot of economic data next week. We get new home sales data on Tuesday and the minutes of the May FOMC meeting on Wednesday. On Thursday, we'll get the latest revision on first quarter GDP and pending home sales. Friday, we'll get another read on inflation when the PCE index is released. We'll also get consumer sentiment and personal income and spending data.
A bunch of retailers will report their quarterly results, and next week we will get lots of different reads on the consumer from specialty retailers like Dick's Sporting Goods, Best Buy, and Lowe's. We'll also hear from wholesale membership clubs, BJ's and Costco. Some of the other companies reporting including Dollar Tree, Gap, and Kohl's.
And finally, JP Morgan will hold its investor day on Monday. We're going to be looking to see what executives say about the recent regional banking crisis, the debt ceiling, and possible succession plans for CEO Jamie Dimon.
Sounds like a busy week ahead next week. Well, it does it for us today on this Friday afternoon. Thanks so much for sticking with us here. We'll see you right back here on Monday, 3 p.m. Eastern Time for all your coverage leading up to and after the closing bell. Have a great weekend.